Good morning, everyone, and thank you for joining us today. We're diving into the comprehensive auditing of long-term debt and equity, where we'll explore the key standards, identify potential risks, outline effective procedures, and discuss best practices for reporting. Our goal is to ensure accuracy and provide strong assurance for financial statements. I'm excited to guide you through this important topic that plays a crucial role in financial transparency and compliance. When we talk about auditing long-term debt and equity, we're looking at financial obligations and ownership interests that stretch beyond a single year. This audit isn't just about checking numbers, it's a comprehensive process that ensures these elements are properly recorded and presented. To carry out this audit effectively, we start by understanding key definitions. Knowing exactly what qualifies as long-term debt or equity is essential for accurate classification. Next, we follow established auditing standards, which serve as our roadmap, guiding us to perform the audit thoroughly and consistently. A crucial part of the process is identifying the risks that are unique to long-term debt and equity. Once these risks are clear, we implement specific audit procedures designed to address them. Throughout the audit, we also focus on ensuring that all disclosures related to these items are complete and transparent, helping to avoid any surprises down the line. Ultimately, the goal here is to confirm that long-term debt and equity are not only accurate and complete but also fairly presented in the financial statements. This gives stakeholders confidence in the financial reporting, knowing the information they rely on is trustworthy and well supported. Now, let's talk about the key auditing standards and guidelines that shape our audit processes. First, we have the International Standards on Auditing, or ISA. Important examples include ISA 315, which focuses on risk assessment, ISA 500 that guides us on audit evidence, ISA 550 which deals with related parties, and ISA 700 that directs the preparation of audit reports. Next, we have the AICPA standards, known as AUC standards, which closely mirror the ISAs. For instance, AUC 315 aligns with risk assessment, AUC 500 covers audit evidence, AUC 550 relates to related parties, and AUC 700 is about audit reports. Then, there's the FASB Accounting Standards Codification, or ASC, which provides specific guidance on accounting topics. For example, Topic 470 covers debt, while Topic 505 addresses equity. For audits involving public companies, the PIG standards and SEC regulations come into play. These standards are particularly important because they enforce stricter requirements on audits of public entities. Overall, the purpose of these frameworks is to ensure that auditors take a consistent and thorough approach to identifying risks, collecting sufficient evidence, and accurately reporting on critical areas like debt and equity balances. This consistency helps maintain the integrity and reliability of financial reporting. Let's take a closer look at long-term debt. By definition, this includes any financial obligations that are due beyond 1 year, such as bonds, notes payable, mortgages, debentures, and lease liabilities. These are significant because they represent a company's long-term financial commitments. One of the key features of long-term debt is that it can carry either fixed or variable interest rates, and it always comes with a clear maturity date, which is when the debt must be repaid. Additionally, many long-term debts come with covenants. These are restrictions or conditions that the company must comply with, often limiting certain financial or operational activities to protect the lender's interests. When it comes to accounting, long-term debt is initially recorded at fair value. After that, it's accounted for at amortized cost, which is calculated using the effective interest method. This approach helps in recognizing interest expense accurately over time. From an audit perspective, there are several critical areas we focus on. First, we need to verify that all long-term debts actually exist and are complete, meaning nothing has been omitted. We also assess whether the valuation of the debt is accurate and reflects the true liabilities of the company. Lastly, auditors ensure that the debt is properly classified as a liability on the balance sheet, and that the company fully discloses the terms, conditions, and any associated risks of the debt. This transparency is essential for stakeholders to understand the company's financial obligations clearly. Equity essentially represents ownership in a company, and it's made up of different components like common stock and preferred stock. Beyond just these stocks, equity also includes additional paid-in capital, retained earnings, and treasury stock, each playing a distinct role in the overall ownership structure. Equity can differ not only in form but also in the rights it carries. Some types come with voting rights, while others may include stock options and warrants, adding more complexity. From an accounting perspective, equity is recorded by combining the par value of shares with any additional paid-in capital, and any changes over time are tracked through retained earnings. When auditors review equity, they focus on ensuring ownership rights are properly recorded, transactions affecting equity are accurate, classifications within equity accounts are correct, and that everything complies with regulatory standards. Finally, it's important to understand that different types of equity often come with varying voting rights, which can significantly influence control over the company. When auditing long-term debt, there are several key risks we need to be mindful of. First, there's the risk of unrecorded or fictitious debt, which can lead to an understatement of liabilities and distort the company's financial position. Next is the miscalculation of interest expense, which directly affects the company's profitability and financial results. Another important risk is the misclassification of liabilities, where short-term and long-term debts are incorrectly categorized, potentially misleading stakeholders about the company's liquidity. We also need to watch for non-compliance with debt covenants, as failing to meet these agreements can increase the risk of default. Additionally, inadequate or misleading disclosures about refinancing arrangements or collateral can obscure the real financial obligations of the company. Lastly, we must be vigilant about potential fraudulent presentations or omissions of debt transactions, which can seriously compromise the integrity of the financial statements. Each of these risks requires careful attention to ensure accurate and transparent reporting. When we talk about audit risks related to equity, there are a few key areas to focus on. First, misstatement of ownership interests can occur if the share counts or ownership rights are recorded incorrectly. This can lead to inaccurate equity reporting, so it's crucial that we ensure the shares are recorded accurately. Next, unauthorized share transactions, like issuing or redeeming shares without proper approval, can significantly distort equity balances. Staying vigilant to detect and prevent these kinds of activities is essential. Lastly, errors in dividend calculations can have a direct impact on retained earnings and cash flow, which in turn affect the financial statements. Maintaining proper calculation methods and verification processes is vital to avoid such misstatements. These are the main risks we need to keep in mind to ensure the integrity of equity reporting. When auditing long-term debt, one of the first key steps is obtaining confirmations directly from lenders. This helps us verify the outstanding balances and ensures the amounts reported are accurate. Next, we carefully review the loan agreements themselves to check for any covenants or specific terms the company must follow. This is important because non-compliance can have serious implications. We also perform analytical reviews of interest expense. By comparing current interest costs to expectations or prior periods, we can spot any inconsistencies or errors in how the debt is accounted for. Examining the debt contracts and related documentation is another critical step. This allows us to confirm the completeness of the debt recorded and understand the specific terms involved. Another important procedure is inspecting board minutes. These records provide evidence that any new debt issuance or refinancing was properly authorized by management or the board. Finally, we test the financial statement disclosures related to long-term debt to ensure they are clear, complete, and comply with relevant accounting standards. Together, these procedures give us confidence in the accuracy and fairness of the reported long-term debt. When auditing equity, the first step is to verify the shareholder registers to ensure that ownership records are accurate and complete. Next, we need to carefully inspect stock issuance documents, making sure that all issuances and redemptions were properly authorized and recorded correctly. It's also important to review dividend calculations and approvals to confirm they have been accurately calculated and properly documented. Testing journal entries related to equity accounts helps us identify any potential errors or fraudulent activities. Finally, we must assess compliance with all relevant regulatory requirements to ensure that equity transactions adhere to the rules and standards governing them. These procedures together help provide confidence in the accuracy and integrity of the equity section in the financial statements. When it comes to financial statement disclosures for debt, it's important to provide details like maturity schedules, the interest rates involved, any collateral backing the debt, the terms of covenants, and any refinancing arrangements that might affect the obligations. These elements give a clear picture of the company's debt situation. On the equity side, disclosures should include descriptions of the different share classes, along with any associated rights and restrictions. It's also essential to explain dividend policies and any stock-based compensation plans, as these impact shareholders and the overall equity structure. Additionally, companies must disclose related party transactions and any significant events occurring after the reporting period that could affect debt or equity. They also need to outline the accounting policies applied and discuss risks and uncertainties linked to these balances. Altogether, these comprehensive disclosures improve transparency and help users better understand the financial position of the company. When auditing long-term debt and equity, there are several key challenges we need to be aware of. First, documentation and verification can be a major hurdle. Sometimes loan documents are missing or incomplete, making it hard to verify the authenticity and terms of the debt. Additionally, verifying who actually owns the shares can be tricky, especially with complex ownership structures. Next, the complexity of financial instruments and transactions adds another layer of difficulty. Many instruments have embedded derivatives, which complicate how we value them. Unauthorized equity transactions also pose a risk because they can lead to misstated ownership, which affects the accuracy of financial statements. Finally, there are significant risks and regulatory challenges. Misinterpreting debt covenants can lead to incorrect assessments of risk. Off-balance sheet liabilities may be material but easily overlooked if not properly recognized. We also have to be vigilant about potential fraud and management override, which can distort reporting. Plus, regulations and auditing standards are continually evolving, so staying up to date and applying professional judgment is essential to navigate these challenges successfully. When it comes to reporting and communicating our findings, there are several key aspects to focus on. First, it's crucial to clearly communicate any identified risks and control deficiencies to management and those charged with governance. This ensures everyone is aware of potential issues that could impact the organization. Next, we need to explain how these findings might affect the accuracy and reliability of the financial statements. This helps stakeholders understand the significance of the issues in the context of the overall financial health. We also provide specific recommendations for improving internal controls and ensuring compliance, giving the organization a clear roadmap for addressing weaknesses. Another important point is documenting all conclusions transparently and clearly within the audit reports. This thorough documentation supports accountability and future reference. Finally, any issues such as non-compliance or material misstatements must be reported promptly. Timely reporting enables quick corrective action, which ultimately enhances the value and effectiveness of the audit process. Transparent, timely communication is really the backbone of making sure the audit drives positive change. To sum up, the first key area is understanding and risk assessment. It's crucial to have a deep grasp of the relevant accounting standards and internal policies. This knowledge forms the foundation for conducting thorough risk assessments, which help us tailor our audit procedures to focus on the most critical areas. Next, when we move into audit execution and documentation, it's important to rely on direct confirmations and keep detailed records of all the evidence we gather. This ensures transparency and traceability. Our main focus should be on making sure classifications are accurate and disclosures are complete. Throughout this process, maintaining professional skepticism helps us identify any anomalies or inconsistencies that might otherwise be overlooked. Finally, effective communication and compliance cannot be overstated. We need to deliver our audit findings clearly and constructively to all stakeholders, fostering understanding and trust. Additionally, it's vital to stay up to date with regulatory changes to maintain ongoing compliance. By adhering to these best practices, we support high audit quality and contribute to reliable, transparent financial reporting.